Welcome to my Accounting 1110 Review for Final on Chapter 3, Part 2. In this example, or in this pencast, I would like to illustrate for you some examples of adjusting entries. Discuss 4 different times, 4 different types of adjusting entries that are required at the end of the period. And I would like to do an illustration of each one of those for you. We'll start with prepaid expenses, our first example on our prior pencast. I'm going to put you on pause and write down a little problem and then have you help me solve it. Let's assume that our unadjusted trial balance shows supplies having a balance of $2,000 in the account. But a physical count on November 30th shows $250 worth of supplies remain. The accounts that we're going to be looking at are the balance sheet account supplies, which has $2,000 in it, and its counterpart on the income statement, supplies expense, which is what prepaid supplies turn into as they're consumed. Our facts show us that there remains on hand at the end of the month $250 in supplies. We need to make an adjusting entry that shows how to change the balance in supplies and transfer it into supplies expense. How about you put this on pause, make the entry, come back, and let's see how you do. Welcome back. How does your entry look compared to mine? I took $1,750 out of the asset account supplies with a credit and debited the expense account supplies expense to show the amount that we consumed for the period. This one adjusting entry fixed 2 accounts. It fixed the balance sheet. It shows that there is a balance at 11/30 $250, the amount our physical count showed. And on the income statement, it shows we consumed $1,750. So our adjusting entry affected both the income statement and the balance sheet. Excellent. Let's look at our second type of adjusting entry that we listed. Our second type of adjusting entry was unearned revenues. And remember, unearned revenues are monies that we've received in advance of performing services. Let me put this on pause and then write down some facts for you to solve a problem with. Let's say that our unadjusted trial balance shows $8,000 in the account unearned revenue. This was received during the accounting period, paid in advance, and that during the course of the current accounting period, we have earned $2,000 of this. Unearned revenue turns into earned revenue, and $2,000 of this was earned as of 11/30. So our unadjusted trial balance currently shows a balance of $8,000. Can you put this on pause and make an entry to show $2,000 of this has been earned? How'd you do? I debited unearned revenue for $2,000 and moved it into earned revenue. So an adjusting entry corrected 2 accounts. It shows that my liability of unearned revenue still to be performed of services in the future, its balance is $6,000, and the amount of revenue earned in this period relating to that unearned revenue was $2,000. Thus it fixed both my balance sheet and my income statement. In these 2 examples, number 1 and 2, we had cash happen in advance of recognition. We paid for supplies in advance. We received revenue in advance. And these 2 adjusting entries corrected that situation. Besides being paid in advance, sometimes we haven't paid revenues or expenses as of the end of the accounting period, but still need to recognize them. That's what example 3 and 4 do. Let's look at our third example, which was accrued expenses. I'm going to put this on pause and draw some facts up. Let's assume we have an employee It's $1,000 a week, and they're paid every Friday. And let's further assume that November 30th is on a Wednesday this year. If you look at how much wages are paid to the employee per day, you'd see that $1,000 divided by 5 is $200 per day. And according to our example, November 30th falls on Wednesday this year. So if you look at this timeline, as of November 30th, our employee has earned $600 of his $1,000 payroll. He will be paid on Friday. Make the entry that we will need on November 30th to show these set of facts. Welcome back. Notice I debited wage expense and wages payable. This sets up the account wages payable on our balance sheet with the amount of $600 in it for the period, which is accurate. We owe the employees $600, and it also gets wage expense correct for November by putting $600 in wage expense for the month. This employee will be paid on December 2nd. In the next accounting period, all adjusting entries for accrued expenses set up a liability. The entry on December 2nd will pay the wages for the week and remove that liability. How about you make that entry for me now? I've only made part of this entry for you, the entry to be made on December 2nd. I know I need to get rid of the amount of wages payable I set up, and I know I need to give my employee $1,000 cash. What's the other $400 to make my journal entry balance? And hopefully you would say wage expense for the current month of December. My adjusting entry that I made on November 30th set up the expense and the payable. My subsequent entry on December 2nd removed the payable, recognized further expense for December, and showed the whole payroll being paid at $1,000. Accrued expenses will always have a subsequent entry paying them. Well, we have one more type of entry to look at, and that would be accrued revenues. The good news is you've been doing these really since Chapter 1, first in worksheet format, and then in the last chapter, Chapter 2, by making a journal entry. Let me write down some facts. Let's assume that you completed some work in November for a client and sent them an invoice. I guess we need some amounts, huh? Let's say you did that in the amount of $200. Well, we know we're going to have an accounts receivable come out of this because we're going to have someone owe us money, and the opposite account on the income statement that relates to accounts receivable is revenue. Given this, can you make an entry for me on November 30th to reflect these facts? Put me on pause, make your entry, and come on back. So, we send out an invoice to a client for $200, and that takes accounts receivable up, and we pick up the revenue. We haven't been paid yet, but we will. Maybe the terms are 210 net 30, or maybe they're just due in 30 days. I guess I should say it that way. We haven't looked at terms yet. That comes with the next chapter, or Chapter 5. Funny. So, anyway, here's our adjusting entry. It affects both the balance sheet and the income statement. It sets up an accounts receivable, and then it shows the revenue being recorded in the right period. Sometime in December, our client is going to pay this bill, and I need to write this in a kind of a crunch fashion. I haven't left myself much room. But next month in December, what will the entry be when we receive payment for this? Go ahead and put me on pause and make me a journal entry that shows our client paying for this next month. Welcome back. Notice I picked up the cash when I received it after the fact, and I eliminated the accounts receivable. I don't need to pick up the revenue. I I did that when I earned it in November. So this has been an example of the 4 types of adjusting entries that we looked at in our first pencast. Need to be made at the end of the month. Prepaid expenses and unearned revenues correct account balances that exist because the cash has already been paid or received, and we're now moving it from an asset or an unearned account to an expense or a revenue. The second 2 entries reflect amounts that have not yet been paid or received, but we have consumed the expense or we've earned the revenue, so we made journal entries to reflect this fact. These are the 4 types of adjusting entries that we make. There is another one that you make for prepaid expenses regarding long-term or long-lived assets, property, plant, and equipment. Since that will take a little longer, I decided to do a separate pencast for that. So come on back when you're ready. Bye for now.